But Gary had a question related to a bull put credit spread, and I'm going to use Ally as an example, just because I know where the price was and it was bouncing around today. And in a bull put credit spread, we're going to sell a put option, and then of course we're going to buy a lower strike put. This results in a credit for the position. And of course, as we get close to expiration, what are the potential outcomes of the trade? So let's go ahead and just use the options from today. We're going to sell the 55 put and buy the 50. Let's say we did this back sometime in September. We'll just use one contract to keep the math simple. Let's say we got $1.50 for selling the October 55 put, and we bought one for $1. I know that's not good. We'll try. Let's just trying to get a reasonable net credit here of 50 cents on the 5-point spread. And this is not really a trade I would suggest doing a bull put credit spread on, especially where the stock where it is and these strike prices I selected. This is just for example purposes. Okay, so this is our bull put credit spread now at expiration. The stock's at 54.90. It fell below the short put strike price. As I mentioned, the stock just jumped up there today. This is not a position I was in. If I was in a bull put, it probably would have had to have been the 50 and the 47.5 or something along those lines. But in any case, we took in a net credit of 50 cents in our example, and we sold the 55 put, which does what? It obligates us to buy shares of stock at 55 if the stock is trading below that price. Going into a spread trade does not change the obligations of the sold option or the bought option. It just gives you a little protection if in case the stock did fall down to $48, $46, or $44 per share, so we know that we're only truly risking $4.50. It's a 5-point spread. The stock's trading below that, we'll lose that 5 points, but we keep the 50-cent net credit regardless of what happens. Now, in this case, the stock was at 55.20, and it was looking to move down. It peaked at about 55.20, 55.30 today, but then it started to pull back down, and it ended 54.90. So Gary's question was, I'm kind of new to this. How do I close out the position? How do I go about closing out this particular position? Okay. Well, if you were looking to close early prior to expiration because the stock hit your trigger point, it moved within maybe 1% of your sold put strike price or something along those lines, we would do the opposite transaction at that time. What did we do? We sold to open the 55 put, and we bought to open a 50. So if I'm going to unwind this trade, liquidate this trade, I have to do the opposite transaction. We're going to buy to close the 55 put. All right, so that's a buy to close action. We sold to open, so we're going to do the opposite. We're going to buy to close, and that might have been at around 15 or 20 cents right before expiration with a stock at 54.90. Now, if at all possible, this close to expiration, an hour before expiration, 20 minutes before expiration, the 50 put is so far out of the money, it might have a bid of 1 cent and an ask of 3, or a bid of 0 and an ask of 3. I might be able to get 1 cent for it. I might be able to get 2 cents for it. I might try if it's worthwhile. And what am I going to do? The opposite transaction. We bought to open as part of the spread, so we're going to sell to close that particular position, and that would be, let's say, 2 cents. Okay, so we have to pay 15 cents to buy to close our obligation at 55. We'd sell to close the other put. Let's say we got 2 cents, so we had to pay 13 cents in order to close the position. We originally took in 50, which could have been an 11.1% return, provided the stock stayed above both strike prices in this case. Both puts would have expired worthless. We would have had the maximum profit on the trade. But with 13-cent buyback costs, we now only profited 37 cents on the true risk of 450. So the return's going to drop on this trade to maybe 8%, 8.2% or so, somewhere around there, I think. Okay, so that's how you'd unwind it, Gary. You have to do the opposite transaction. Buy to close your sold put, the higher strike, sell to close the bought put, the lower strike, and you've liquidated the entire position. Now, of course, if both legs stayed above $55 at expiration, I don't have to do anything. If the stock was trading at 57 or 58, I'm not worried about it dropping in the first 10 minutes or so after the market closes at 4 o'clock Eastern time. Then I just do nothing. I leave them alone in the position. Both puts expire worthless because they're now out of the money, and I keep the full 50 cents, Gary, and my 11.1% profit. Now the tricky part comes. And say I didn't close this position. I left the short put open at the 55 strike. I forgot about it, wasn't paying attention, or I figured it was not going to move up almost $2 today at one point, or $2.20 at one point. And well, okay, that's reversed. That's what I wanted to have happen, but I didn't think it was going to pull back down below 55. Let's say it fell $2.20 today, and what looked like a positive trade is now going negative against me. If I didn't close this position prior to expiration, what do I have? Well, my long put, the lower strike put, still expires worthless. It's still out of the money. The stock's at 54.90. This expires worthless. I did not cancel this obligation at the 55 strike. Essentially, this is the same obligation of having a cash secured or a naked put sold against a stock where the stock has now fallen below the short put strike price. I did not close it. So on Monday, I'm going to own, in this case, 100 shares of Ally Financial at $55 per share. I'm going to be assigned because I let the short put remain in the money through expiration. I have to fulfill that obligation. Now, my broker would have only required me to put up the 5 points to cover the spread in this situation. But this is the potential that I may end up buying shares of stock. That is an outcome of this position if you allow the stock to be between the two strike prices and you don't close out your sold put obligation prior to expiration. Now, if it's below both, your broker just closes out both and you take the full $5 loss. There is the potential here that we might own shares of stock. Now, this is okay, provided I had the capital and I didn't get in trouble because I didn't have enough capital to buy the shares of stock at the strike price. If I'm still strong on Ally, if I'm still neutral to bullish on Ally, I now have 100 shares of stock. I kept the 50 cents, so my cost basis is $54.50 on a stock trading at $54.90. I could now turn it to a married put, a covered call position, a collar, or look to just sell to close the stock on Monday. Hopefully it moves up at the open and I can get a little more profit on the position as well. But if it stays at $54.90, we just sell out the position. In that case, at $54.90, get a little bit of a 40-cent profit from our original cost base. So what does that mean? Does that mean I made 90 cents? No. This $54.50 is including that original 50-cent net credit. I sell it at $54.90. I only make 40 cents, so that's our 10-cent loss, which it would have cost me roughly to buy to close the put option just at expiration or in the last few minutes before expiration as all time value went out. Yes, the market maker is going to charge me 11, 12, 15 cents, something along those lines. But again, those are the outcomes. Stays above, both puts expire worthless, you keep the net credit. Full profit. Falls below, you're still going to end up buying shares of stock at the short put strike price, but then your broker's immediately going to sell to close them at the long put strike price. You'll take the $5 loss, but we kept the 50 cents, so it's only a $4.50 loss. Yes, that's a 9-to-1 risk-reward ratio. That's sort of common with these credit spread approaches. If the stock is between the strike prices, the third outcome, and you don't close the position, you may end up buying shares of stock at this price, or you'd look to buy to close it before expiration. Still have a loss, but maybe not the full loss on the trade. And that's why, as a general rule, if the stock reaches within about 1% of the short put strike price, we're going to look to buy to close the put, do an adjustment, roll the position, maybe do a pendulum adjustment, perhaps something along those lines of the 8 ways to manage a bull put credit spread that we discuss as well. All right. So that's for Gary there on outcomes and closing out a bull put credit spread. On that note, okay, David says, previously in the bull put, you've used a 50% as a stop loss. What numbers are used to calculate the 50% loss? The true maximum risk, David, we just discussed. So in this spread at 450, is the maximum loss. That's the maximum I can occur. So I'm going to look, if I liquidate this position, the cost to buy to close the short put, David, and sell to close the long put reaches 225, reaches a total loss of 225. That's the 50% of my maximum loss. That's when I'm going to close out the position, because I don't want to take that 9-to-1 risk reward ratio, losing 4. If this is the standard that I have, mine's a little higher. But if the general trades I'm looking for with a high probability are at about 11% return, making 50 cents on a 5-point spread, 20 points on a 2-point spread, that is still a 9-to-1 risk reward ratio. And I probably have a 90% probability, 88% probability or more. But I'm taking a 9-to-1 risk reward ratio. If I let this position go to full loss, the $4.50, I've wiped out 9 previous trades with this structure. That's what I don't want to let happen. If I hit the halfway point, close it out for a loss of 225. Okay, so maybe now we've only wiped out 4 or 5 trades. And that's still bad, but it can be managed. Why don't I do it at a third of the value? Because I was closing too many positions. Okay, if I took this and said, hey, I'm going to close it when the total liquidation value on this spread is 150, taking into account the 50-cent net credit, and the liquidation value, David, to close it was 150, 1/3 of my maximum risk, I may be closing positions too much, and instead of getting near that 83, 84% probability, I might be down to 77, 76%, and that win ratio is not going to be enough to be profitable. Even though I'm controlling the losses, I'm just not getting enough winners. Okay? Okay, and on that note, oh, sorry, David, so I hope that answers your question. If you're not clear on that, let me know. But that's how I measure the 50%. My maximum risk that's known, even if I take the full loss, is 5 points, but I keep the net credit, so it's only 450. I'm going to look to set an alert. Yes, Kipp, but I look to set an alert if the liquidation value is at 225. Kipp then followed up, do you typically set an alert for the max loss level? No. And here's what I mean by that, Kipp. When I enter a position, we'll do a walkthrough in just a moment, Kipp. When I enter a bull put credit spread, I'm going to set a few alerts in the portfolio. I'm going to set my 1% risk. I'm going to know what 1% of my short put strike price is, and I'm going to put that as the lower limit for my stock price. And I'm going to put in also a change, of course, in SMA as well. Excuse me, SMA 20. The stock drops below the SMA 20. That might be an early warning sign that I may look to manage the position, Kipp, as well. Why am I not setting an alert on the max loss? Because normally I'm closing in this area. Okay, somewhere around a 35 to 40% loss of the maximum loss expected. I try never to let anything go to maximum loss, if possible. I haven't had one go to maximum loss that I can recall, honestly. And in that, that mentioned that first date back on February 5th through 9th of 2018, when the discussion of the China trade war started and the market just collapsed. I had 3 bull puts open. On that first day, they all went to an average of a 49.8% loss. One was a 28% loss. One was a 60% loss. It's pretty big. And one was right around 51 or 52. So it averaged out to be 49.8%. The next day, the average loss was 72 on all 3 positions. And the following day, one position was at a full maximum loss. I closed it before that happened. I understand it can happen, and suddenly you wake up in the morning and the stock's below both strike prices and you're at a 95, 98% loss. Well, yeah, in that case, I don't know what I'm going to do. Likely, I'm going to close it. I'm likely going to analyze a pendulum adjustment to see if it's even possible to shift that with what's changed, but it's not likely to work when it's that far below both strike prices. That works best when it's between the strike prices, simply converting the bull put credit spread into a bear put debit spread with one move. But, Kipp, let's take a look at those alerts. Kipp says that's very helpful. Thank you. David says it's crystal clear. Excellent. But let's take a look at the alerts. Let's go to bull put credit, search. And as you know, I'd normally be opening my positions on Monday, early in the afternoon, rather than on Friday. Let's see here. Let's just find a nice, simple one. Mara. Wow, they had a good jump today, didn't they? So did Coinbase. I wasn't paying attention to Bitcoin today at all. And FedEx there as well. I'm just going to use Marathon Patent Group. It's nice 39 strike positions here. Okay, so it's a 39-37 spread. Not as high as I'd like. I'm normally up here in the 15, 16% range. But in any case, we're getting a net credit of 23 cents at midpoint on a 2-point spread. Works out to a 13% return with an 86.3% probability above. Okay, so let's just take a look at the profit and loss chart. Very similar. This is for 14 days out for our preferred structure. And you haven't looked at the stock chart yet. This is not a recommendation or suggestion. I'm not doing any further analysis on this. This is just in relation to this example. 39.37 strike, 23-cent net credit, about 66 cents and 43 cents there. That's great. And 13% return as long as the stock stays above 39. It's currently at 48.89 through October 29th expiration. All right. Now I'm going to add it to the portfolio. And we'll just call it, okay, there we go. Bull puts 2021, open the position on 10.15. We're just going to round this down a little bit. 66 cents, sell to open our 39 strike put. Buy to open the lower strike at 37 for 43 cents. That's going to give us the 23-cent net credit. And here's our Mara bull put position. Now, the 1% rule, I didn't really mention this, but I showed it on the graph, but I didn't discuss it. The 1% is based on the short put strike price. Okay. Oh, and David, I'm sorry. We have a 2-point spread and a 23-cent net credit. Should have looked at that on the profit and loss chart. Oh, there it is. Okay, yeah. So my true risk is 177. So naturally taking half of that, where are we going to be? About 88 cents, 89 cents, I believe it is. So that's what we're going to look for there as our halfway stop of the total maximum risk as well. Okay, 89 roughly. Yeah, 88.5, but yeah, 89. We'll just call it that. Okay. The third column in the portfolio is the alerts column. We can set the alerts in each position by just clicking the view link. And again, we're at $39 on our short put. We're going to set the lower limit for the stock to be $39.40, 1% of our 39 put strike price. Okay. So we have leg 1 and leg 2. Again, it doesn't matter which one you put it in. Let's just keep it straightforward, though, since we are talking about our 39 strike put, David. We're going to put this in at $39.40, and I'm going to mark it as red, as I mentioned, to alert me that the stock was within 1% of my short put strike price, and I might seriously want to consider taking action sometime soon. Now, another thing, we could use the position percent change, increase or decrease in the total position. Sometimes I do that as well. What I'm definitely going to do is put an alert on the simple moving average to let me know if the stock is trading below the 20-day moving average. Why? That's one of the criteria that we like to use for that default bull put credit spread search, as well as the MACD. I'm working with the programmers to get a MACD alert set in here too, so I can see if the MACD is turned negative. But in this case, this is a warning sign for me as well. Would I open a new bull put credit spread if the stock was trading below the 20-day moving average? Probably not, because it doesn't match my criteria. So while I'm in this position, if the trend that I wanted to get into changes, we're going to make sure that we're going to be set an alert for the stock price to be less than the SMA 20. And again, I'm going to mark that as red. In positions such as married puts, collar spreads, or covered calls, and things along those lines, I may put in a days until earnings, if I'm within 3 to 5 days to earnings, to know when to make an adjustment, or the days until X dividend. I don't worry about that with the bull put credit spread, because all of the positions that I would trade off of that default list already have the earnings checked in the search. We're not showing any positions that have earnings between now and the expiration, so I don't worry about that here. But those are the two I'm going to look at. There's my 1% in the alerts in the portfolio, and of course there is my stock below the SMA 20. And if you use Bollinger Bands, you can set those as alerts as well. All right, so we just save the alerts, takes us back to the portfolio. And now I do see here my lower stop limit is set at $39.40, so that's going to trigger alert when it's hit. It shows you which alerts you have based on the stock price. Or I can set, as you saw, an individual price for the option. Say that this went up to $1.20, it doubled in price. I could put that in for a stop limit on the option as well. but I just prefer to do it this way based on the entire position rather than each individual option itself. All right, so that's how we set the alerts there. Sorry, I got stuck on the page for a moment. And that's what I would do, Kipp, in this scenario, and David as well, with setting alerts, with putting in a new bull put credit spread, or any strategy, really. Always set my alerts on those positions when I put them into the portfolio tools as well. All right, fantastic. So good discussions there on the bull puts, closing the position, setting the alerts in the portfolio, and more.